This lesson is going to be about external range demarkers and how we also work within the PD array matrix, working within premium and discount arrays. The real highlight is going to be the external range demarkers and how they work within the grand scope of things. All right, so on the daily chart of the dollar CAD, okay, we said we have the high here and a low here. This is an intermediate term price swing. What makes this an intermediate term price swing? It's not these small little fluctuations that move back and forth. The moves that take place that have a sizable, more pronounced magnitude on a higher time frame, like a daily or a 4 hour and 1 hour, they, to me, as I classify them, as an intermediate term price swing, because I can use that to frame intermediate term analysis versus something that would be like a movement from here to here. This is too small. Okay, so it's a short-term price swing. While that's available for profitability if you are buying along in there, and it's nothing, I'm not against it or anything like that. I'm just stating that my eye, or at least I've trained my eye to look for the intermediate term price swings. Now, again, what defines the intermediate term price swing is any sizable price swing from a daily, 4 hour, or 1 hour perspective. Okay, anything less than 1 hour is not an intermediate term, and anything higher than a daily is a long-term price swing. Okay, so, and we'll talk more about, obviously, there's plenty of examples that's coming your way with other things that we have to use for intermediate term price swings. It's just that's what we're focusing on here. So, when we have an intermediate term price swing high and an intermediate term price swing low here, you want to define that range in terms of the PD array matrix. Okay, so you're going to split that in half right here. There's your 50 level. While we're in the lower half of that range, if we have a bullish inclination, in other words, if we have a slight bullish bias, while we are in the shaded area that's blue, you want to focus on buy scenarios on discount arrays on lower time frames. Okay, when we drop down to an hourly chart, you'll see what I mean by that. Everything dovetails beautifully if you understand the algorithmic principles and protocols. There's certain things you have to look for at certain times. Just because you think you understand a down closed candle may be a bullish order block doesn't really equate to always being a high probability bullish order block. Okay, so much in the same vein as I released and taught you all in the mentorship, what makes a high probability bullish order block, one of the signatures is it has a fair value gap associated with it. That's one signature, but an amplification of that would be also within a shaded area like this blue area here. That is necessary. Everything else is going to be hand drawn. Okay, so with that out of the way, I want to talk about how price in this area here, while we're below the 50 level, on a lower time frame like a 4 hour or an hourly, we're going to dismiss the 4 hours simply for the sake of time, but we're going to drop down to an hourly chart. I'm going to show you how using the PD array matrix and the discount arrays. Now, if you have not mind what PD arrays are in what order and so forth. But looking at the daily chart, anything above the 50 level is now a premium array. Okay, so anything above here, this 50 level, this is a premium array. I have highlighted one premium array simply because it's the most salient for this discussion. We have a fair value gap in here. This candle's low and this candle's high. Right here, this candle's high and this candle's low. Originally, it would have been this candle's high, but this candle went slightly higher. So it left this little bit of a fair value gap in between. Simply one candle passing through the range defined by this candle's low. And again, this candle's high. Okay. So on this particular day here, on June 9th, we gapped down at the open below equal lows, relative equal lows, and then we started to close in and close the gap, if you will. We had created a swing low here, this candle. So now we have a swing low. Once that forms, this day right here on the 10th, let me put it on there so you can see it again. On the 10th, you want to start going into your lower time frames and seeing if price is respecting bullish discount arrays, with the expectation that we trade back up into the bearish order block and the buy side liquidity resting above these highs into the fair value gap. Notice also that is also a confluence of this down close candle here and these two down close candles. Either of these, okay, are going to be a premium array. We have breakers and mitigation. So there's several things in here. Just because of this range defined being high here and low here, we can look beyond that a little bit, because think about how we look at breakers. We have to go a little bit further to the left. You can see the breaker here, a mitigation block in here. Everything that you would look for resistance theory, okay, or buy side liquidity to offset your long position. So you're going to sell to those individuals that would be interested in buying at a higher price. That's what we're doing. We're pairing orders. The interbank price delivery algorithm facilitates the means for smart money to engineer, offset, and purge liquidity. If these functions were not available, we would have a completely random market. But obviously you've learned that there's ways that we can be consistent with all this. When price goes below to tap into the sell side liquidity pool and dip into this BISI, buy side imbalance, sell side inefficiency, using the institutional order flow entry drill technique, all it has to do is come down to that low, and that'd be enough to get an entry. Okay, so if we're looking for a bounce in here to trade back up into a premium array, which would be a bearish order block here, buy side liquidity pool, fair value gap, breaker mitigation, we can use the time while it's in this blue shaded area all the way up into, which it leaves it and goes above the 50 level of that range on the 14th of June. Okay, so for 4 days, we have the opportunity to study and look for opportunities for longs based on discount arrays. Now, when we have this in play, we could be looking for the external range demarkers. And so if we drop down to an hourly chart now, here's that gap opening. So there's no candle in here. Okay, we have a gap. So price comes back up, closes in the gap here. Is that gap efficiently balanced at that point? No, it's not. Only until it trades back down on this candle is it really balanced. Reason why is we have this gap in price. It's a volume imbalance. And what's a volume imbalance? It's a missing range of price where only a previous candle and the next candle defines it. So it's a gap, basically. It's a simple gap. When price trades up, gap theorists say the gap is now filled. So therefore, it's no longer salient. That's not true. Price has only been offered on the buy side here. To be efficiently balanced, price will be dropped lower. So it gives us a buy and a sell. In other words, price has moved up and down in that range that's created that gap, or what's shaded in yellow. So once the price has been balanced, we have to wait for displacement. Okay, displacement is when IPDA moves strongly in one direction or the other. We don't really particularly care. But in this instance, we want to see if there's a willingness to go higher. And it does create a displacement here. Price creates a run, leaves an imbalance. So this is a BISI, buy side imbalance, sell side inefficiency. It's defined here. Now, at this point, when this candle closed and it was trading here, this was a fair value gap. But because we went down into the fair value gap here, now this becomes a buy side imbalance, sell side inefficiency. That is the distinguishing factor between a BISI and a fair value gap. So that way you understand what that is. And the reverse is said for SIBI and fair value gaps when it's a bearish inefficiency. Price creates a run down into this BISI, and this is the actual low of that candle, and I have a Fibonacci just laid over top of that to delineate the central portion, okay, or consequent encroachment of that gap. Every wick is a gap, just like this is a gap here. Okay, this right here is a gap. It's not commonly referred to as a gap or seen as a gap in other schools of thought. So regardless of who you're trainer was, whoever's trading or whatever, I don't care how long they've been trading, they're not going to look at a wick as a gap, but that's exactly what it is. The market is stretching or reaching for liquidity and doesn't stay there very long. So as soon as this candle closes, we can see there's a wick there. So there's that wick. Okay. So if we can think about where this wick's midpoint, okay, or the consequent encroachment of that gap, because it's created a gap from where it's closed and where its low is. If I put it back on, it'll snap right to your open, high, lower, close. There's your midpoint right here. This is all you need, plus spread. If you miss this entry here, you can take a fill, anything less than that close. Ideally, you want to see it trade down, find some support at that midpoint. Again, the midpoint is shown here, 25.3. Price creates an external range demarker here. Then you can participate as a long entry at that price point here, or anything below the previous close. It helps you define specifically where you're trying to get in at and what is a really discount entry point. Price clears this high here, and this here is old high. Creates an imbalance again. This is a fair value gap. Why is it a fair value gap? Because it's only one single candle, and nothing comes down into it until here. Bullish order block. 3 down closed candles. We have displacement. Bullish order block. Fair value gap. Overlap. Price can be bought here on the 13th. Now notice also, 13th, here's the 12th, here's the 13th. You're buying it down here in the wick, low. Closing in, all of the buy side delivery, sell side's been now offered on the next day. Going back to the hourly chart, price runs from that low, leaves these 2 down closed candles, bullish order block again. Same thing occurs in here. Take your fib, we have a wick dipping down into a discount array. This was a discount array, the BISI, trading down into a discount array. This right here is a discount array. If price comes back down to it and it's a bullish order block, you could be a buyer there. No real wick to work with in terms of an external range demarker. We do have one here trading back down into the order block. So if we take our fib, drop it on here. Let me be fair about it because I want to make sure it goes right on the low. Okay, you can see it's hitting right there. That price level, 33.18.1. The low, 33.18. Again, off by 1 pipette. So buying below this candle's close and between this expected low, anywhere in there is an ideal entry point using external range demarker. Another support area found on the order block here. Price creates another imbalance. These are fair value gap, bullish order block. Again, same price structure here. Price stabs down, closes in the gap. We're going to measure that wick as it dips in. Okay, and the low, I'm sorry, not the low, the consequent encroachment on this is 33.31.6. This candle, 33.30. So it's less than 1 pip. Now, extending it out 4 days, okay, so this is day 1, 2, 3, 4, you get to fill again here as well. So below that candle's close to this price level in here, anywhere in there, if you target that as an entry, that's ideal. Now, this is your previous swing low, so your stop would have to go below that. So even though we had a little bit of an overzealous movement here, it didn't take out this low, and it certainly didn't take out the previous swing low. Okay. Price rallies again, creates another fair value gap. And this is on the 14th. This is that day here. Okay, so that's when we have that big surge. This run up here creates a fair value gap. Price comes down, consequent encroachment nails it beautifully. Splitting the range again here. This is that gap on that wick as it closes in that fair value gap or taps into fair value gap's consequent encroachment. There's your price level, 33.96.7. The low, 33.95.6. 1 pip again, off by 1 pip. So the range is buying below this candle's close to this price point. Okay, anywhere between those two price points. Again, the close is 34 and consequent encroachment is 96.5. That is not a zone. It's not ambiguous. Okay, it's very specific about what you're trying to buy. Why? Because it's bullish. Until when? Here's that 34.29.50 level. That's over here. This level, this high. 34.29.5. Okay, there's your minimum target. Okay, it needs to trade there or higher to fill it. On this day, on the 18th, it trades to 31.4 or 31 and 4 pipettes. So it only goes over essentially just about 2 pips. Once it trades here, same thing. We're looking at that range that's being defined by the wick midpoint right here. The price is 34.29. The next candle's high, 34.29 and 7 pipettes. So selling above this candle's close to this candle's consequent encroachment on its wick of 29, you know exactly what price level you're trying to sell short at. And this reaction here, you would be targeting the liquidity resting below here and then completely closing in the BISC that would be remaining on the daily chart. Every one of these here, okay, these are very specific. It's not supply and demand zones. It's a very specific criteria. We have to trade down into a discount array each time when we have a bullish context. And also, big point, we're in a discount market. Okay, intermediate term price swing. We're anticipating another intermediate term price swing higher. What's it going to reach for, Michael? Well, you got to start looking at the bearish order block first. And if it goes through that, then you can look for the buy side liquidity and fair value gap, breaker, mitigation block. All of those factors. But everything goes to the low probability once we get above this midpoint. Okay, and if I highlight that, you can see the price level. 34, big figure. Basically 34.01. And 34.01 is right in here. Okay, so probabilities fall off precipitously once we trade above that. But look what we left, equal highs. So you come down, pick up one more discount array, and then send it higher on the 18th, and then it just takes a bath. Okay, so hopefully this has been a little bit more insightful to you what a external range demarker is. Look at examples like I just marked up here. Use the benefit of hindsight. Mark up your charts and see where these external range demarkers occur. And remember, there's 2 of them. There's one that creates the low, and then it goes with a lower low, but it's basically just a measurement of the entire range duplicated. So if there's a previous wick and we trade lower than, and I mean significantly lower than consequent encroachment of the first wick, then you would anticipate a duplicate range, okay, or a standard deviation of 1. Whatever that initial wick was, it'll be another one of that. Okay, and like I showed in previous introduction to this theory. And then obviously there's other ones where you have price creating just to return to the initial candle's consequent encroachment, and that would be the extent of the low. So we would create a higher low. But this is occurring, this whole function, this is all happening in an area where you would be at a discounted array. Now, it would be reversed if we were trading up into a premium array and things were bearish. The same criteria would be seen just in reverse, where you'd have price creating the initial wick up into the premium array. It could be a bearish order block. It could be a fair value gap that's bearish, a SIBI that's been closed in. All of those are premium arrays. We can get this formation, or the next candle. If it trades up into a premium array on the first wick, then we don't need to anticipate a higher candle. We would just look for it to trade back up to its consequent encroachment of the first candle wick. So that would be like the lower high. Okay, just study these examples in here. Okay, and then go through and find a market that was bearish. And I'm going to leave this with you for your homework, and then we'll look at one on Friday. Don't feel, confused or reluctant to put any consideration into it, because believe me, you're going to want to learn this one. It's really, really nice. It helps with, it's kind of like a second chance entry, or it could be a refinement, or it could be your confirmation type thing that you look for. Okay, because some of you would want to see that. It helps provide that sometimes. So not all the time, but sometimes. But again, without the market creating a wick into the discount array, or in this case when we were talking about if it was a premium array where it's stabbing up into something that we would see as bearish, unless it creates a wick, then we can't even consider the external range demarker. They're not going to be considered at all. So in other words, if we had like butt-ended candles like this, they're not going to create this scenario here. Okay, so it's something entirely different. We're just looking at the entirety of the fair value gap being closed in and then returning back to the fair value gap and order block combination. There has to be a single wick created as it's going into the PD array. Okay, whether it be discount or premium, doing so. Okay, but we're going to go into more of it just in a reverse perspective for the sell side. So we'll be looking at premium arrays on Friday with this example. Again, we're talking about external range demarkers, and I guess if I put that up on the screen. So that's for your notes. Keep that in your book. Nobody talks about these things. It's all me. Okay? So just understand that you'll learn more about it in the opposite end of the spectrum, from a premium to discount, on this Friday. So on the 5th of July, we'll talk about that, and you'll get some more insights about it. But that won't be the last time we talk about it. Again, we're going to be spending some time with it because it's important to understand not all candles close butt-ended like this with very little wicks. Many times it creates these wicks, and they are signatures. They tell you a whole lot. There's accumulation that's taking place in there, and it is vital information for you to understand timing and also picking out setups. Okay, folks, welcome back. We're going to be talking again about the external range demarker. This is a bearish example, and I mentioned we would be looking for a run below this old low here on February 25th, 2019, attacking the sell side liquidity pool. This day here, this is June 25th, 2019, we have a wick. Okay, we have a wick on this candle as well. This candle goes approximately into the midpoint of this one. I don't have it on here because it's going to create a whole lot of clutter on the chart. But visually, you can see it does on this day. We open, trade up, midpoint of that wick, which is the gap. Okay, it's external range demarkers within the wick. Okay, we view wicks as gaps. So the consequent encroachment or midpoint of that wick would be here. This candle here is June 25th, 2019. We run the fib on this as well, project that out, and it gives us a specific price range at 31.95.8. And if we look at the mid figure on the fib here, it's 131.95, measuring this previous day's wick. So this day, on the 26th of June, we open at 31.77, we rally to a high of 31.94.4, and we move a distance of 131.06 as a low, closing at 131.22. So essentially, the high here at 131.94 and 4 pipettes, we are expecting a run back to consequent encroachment to 131.95. Why would we expect that? This candle moves outside of the range of this last up close candle, which was trading back inside of this fair value gap. So all of this in here, okay, this was an original fair value gap, becomes a BISI, buy side imbalance, sell side inefficiency. It's been recalibrated to this level, but we have a BISI in here, and then we have the consequent encroachment here. Price trades right up in the middle of that, hits it on the 21st of June. So we have a bearish order block here. It sets the stage for any movement back up into this candle once we trade below it, which it does here. So the next day, we're inside of the range opening and trading back up into also the midpoint, essentially, or mean threshold of this bearish order block. So right away we have a few things overlapping for confluence. 31.95 is our specific price level. Again, that would be targeting a run below the low here, which we'll note at 31.10. Okay, so 131.10. Nice round number. So from 31.95 or thereabouts, or the range of this previous candle on the 25th. So to open at 31.83 up to 31.95. Any price level between those two price points is a high probability short. You're trading inside of power 3. So it's opening, rallying up, and you're getting a fill between 31.95 and 31.83. So it's about a 12 pip window of opportunity. But let's take that information and take it down into a lower time frame, and we'll go into an hourly chart. I'll bring in the information here, and we're going to put our daily dividers in also. This will help delineate between specific days. Now again, the 25th was that day we created that wick. We're trading up into that run up here. We're also taking that range. Now again, I'm going to add a horizontal line and put it on 31.95 even, and I'll walk you through everything that took place here, and you'll see the beautiful precision across the board with all of this. But let's take a jump back before into the previous week. Here's June 20th. Okay, we have a fair value gap residing here. Rejection block, last up close. Okay, and then we have, which is a buy side liquidity pool in the form of a rejection block. Price trades up, creates a wick in here. Trades up into the fair value gap. This activates the fair value gap. This is your institutional order flow entry drill concept for entry. All you need to do is trade back to this high here. That would be a fill. Let's say you missed it. Okay, you're looking at an hourly chart, and when this candle closes, you can have this range on the wick measured here, and this will give you your specific price point. Now, if I highlight the fib and look at the price point here, it's 32.24.7. So basically 32.25. And the high comes in at 32.24 and 9 pipettes. Okay, so the way you use that is the previous day's body, right in here. The close is 32.20. So 32.20 to a projected consequent encroachment on the wick at 32.24 and 5 pipettes, or basically 24 pipettes. So we only have a range of basically 4 pips. Now the way you can do that is, if we open, as soon as we open and start to trade higher, and you're watching price at the time when it does it, at a kill zone or Asia or London, you can go short immediately as soon as it trades above the previous close, and you want to try to get your fill as close as you can to the consequent encroachment, but don't fancy dance with it a lot, especially when you have such a small little range to work with. Me personally, as soon as we traded above the previous day's close, I would be going short. And because you're using the rejection block here, buy side liquidity pool, and you've already tapped into a fair value gap, so you're most likely going to see price erode and go lower. Then we have price coming back up into it, and before I do that, let's note the elements of the PD array matrix, because it is important. So here's the 50 level. So we are absolutely in a premium market relative to this price swing here to here. Now you're going to ask me, why did you use this swing high, Michael? Doesn't matter, because if I use this swing high here, that's all I'm doing is anchoring to swing points. Here's your 50 level. We're still at a premium market. Okay, so don't beat yourself up trying to figure out what's the reason why. I used the most highest one here prior to an up close candle. That's all I did, is a swing high. Now if I take this opportunity here and I go short, I could be targeting these relative equal lows. We have a swing back up in here. Now again, I'm going to measure the fib for the price swing from here down to this low right there. You can see we are in a premium market. Trades up to this price point here. Bearish order block. price makes a run lower, breaks lower here, but does not get below here yet. One more time, trades up, and then we start consolidating. Again, this is an hourly chart. We have a buy-side liquidity pool here, equal highs, 2 clean. Last up close candle prior to the move down, the displacement is lower, institutional order flow is bearish. All premium arrays and bearish order blocks and breakers and such, they are providing resistance. So that's how we know and classify institutional order flow as being bearish. So this bearish order block, we're extending it out in time. We have this run up in here. Now also this run is trading above 131.95. So 131.95 is being breached here, which is not important yet until the 26th. So that's our important reference just for the 26th of June. So this wick in here, okay, even if we break that down and split it, we have the initial run into the buy-side liquidity pool and the bearish order block with this wick. As soon as we get that, if we see price create that wick, we can do the measurement here and get the midpoint, which would be here, exactly at that 31.95 level. So again, we project that out in time. And we also do our standard deviation of the previous wick, doubling that up, and it gives us the exact range high on this next candle. So you can be a seller or going short above this buy-side liquidity pool, targeting this level here to this level here. So all of this range in here would be an ideal area to go short. Let's take it 1 degree further in terms of precision. All right, so I'm going to show you with the fib here. So here's where we're measuring the initial run above the buy-side liquidity pool here. Draw your fib down, drop it. Now what I have here is the fib. I'm going to pull this away, keeping on the close. We're running right up into that level. Just fall short of it, moving it manually. In this area here, this is your sweet spot for going short. So you have a range of about almost 10 pips or so. So anywhere in here would be an ideal area to go short. Notice that we have price above on both wicks above the buy-side liquidity pool, also trading inside the bearish order block. Using that as your entry tool or entry technique, you can be short here. If you do not get that, we can resort back to the daily level here that takes you to the 31.95 level, using the wicks on the previous day on the 25th. So on the 26th, that 31.95 level that would be our projected high of the day. It also works within the midpoint of this initial wick, as you can see here. So what you would do is you would now use the rejection block. So you have the rejection block, which is the highest up close, and to that 95 level, 31.95. So in this area here, we could be going short. Also, again, basing it on the external range demarker relative to the wicks on the daily chart, and then transferring it to an hourly chart, that 31.95 level, and the previous premium array, which is the rejection block. Notice there's no bearish order block in here, this range. Okay, if we measure the range on here, and again, this is an hourly chart. This is the only lower time frame that I'd like to use it on. Again, here we are, trading it back up above the 50 level, which makes this a premium market. And the only premium array you have here prior to running this high out, which we wouldn't be expecting because we've already had 2 scalings of the wick here and then another measurement higher. So we have the previous day on the 25th creating a sell scenario, and then we have that 95 or 31.95 level relative to the external range demarker on the daily chart, transferring that to 31.95. So that's our highest price point to the rejection block. There's your range. So in between those 2 price points, the close is 31.90. So about 5 pips, less than 5 pips. So how would you use that? You could put a sell order in immediately as price trades above the rejection block, and it keeps everything scaled down, and it's very, very tight in terms of the the drawdown that would be associated with the entries and the setups. So the point in all this is there's no real, I guess, magic to using like this long wicked candle here. Just because it's a long wicked candle, you can't say, well, that's a doji or that's a pin bar, so therefore I'm going to be a buyer, based on this, because look what happens. It doesn't do anything for you. Okay, we're using real reference points in IPTA and price delivery to cause a narrative that we'll follow in the marketplace. It's not that we're looking for any old, quote unquote pin bar, okay, or a doji, and nothing like that. We're not. The premise is not on the individual candle. Okay, the premise is really based on the PD array matrix, and then working with the PD arrays, premium to discount arrays, the bullish order blocks, bearish order blocks, bullish breakers, bearish breakers, bullish mitigation blocks, bearish mitigation blocks, fair value gaps, liquidity voids, equilibrium, okay, buy side liquidity pools above an old high, sell side liquidity pools below an old low, bearish rejection blocks, bullish rejection blocks, okay, how they scale out. And again, when we taught you the lesson in the core content relative to the PD array matrix and where those PD arrays are nested inside of a dealing range, that is the order of what you're looking for. Notice there again, there is no fair value gap in this price run here. There is no, once we're trading here, there's no breaker, there's no mitigation block. It's only the rejection block and then what would be above the high, which would be a buy side liquidity pool. But we're not expecting it to trade back above here because we've already seen signatures that it's already created a turning point. And this is just a return right back to the rejection block and right back into the 31.95. Now, if I were to ask everyone, if we were all in a room and I'd say, okay, look, pull up your data and look at the candle on June 26th, okay, at the Asian session, okay, and what was your high on that specific candle? Some of you would probably show 131.95 or a little bit higher, okay, or a little bit lower. It doesn't make a difference. We're not trying to nail it down to the smallest pipette. There's going to be times when it does that, which is remarkable because we're working with retail skewed data. But it's important to know that if we get very close, very, very close to it, and we're able to define a specific price range between a premium array, which is the rejection block here, and a specific price level, a very specific price level, and it's a 5 level, so 31.95. We already talked about the importance of that in the core content. A 0 level or a 5 level, banks are going to want to work with that. So we have a range in here that we could try to get our retail, quote unquote, entry in for our order, just selling it at the market. Now, if this was a little bit longer or wider terms of a range that would permit a limit order, then you can simply do a limit order above the rejection block. But in here, you may not be offered the opportunity and afforded the luxury of having a limit order because the range that you're working within is too tight.